Hello, and welcome to Forex Trading 101. I'm thrilled you're here to begin this journey into the world's largest financial market. Before we dive in, I have a quick but very important message. This course is for educational purposes only. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The content you're about to see is designed to teach you the mechanics and concepts, but it is not financial advice. You should be aware of all the risks associated with Forex trading and seek advice from an independent financial advisor if you have any doubts. Always remember, you should never trade with money you cannot afford to lose. Now, with that out of the way, let's get started. Over the next few minutes, we're going to build your foundation from the ground up. We'll cover everything from what Forex actually is to how to place your first trade with a solid risk management plan. My goal is to make sure you walk away with a clear, step-by-step understanding of how this market operates. And if you find this tutorial helpful, please give this video a like, share it with anyone else who might be curious about trading, and subscribe to the channel and hit the notification bell so you never miss out on our future lessons. Let's get to it. So what exactly is Forex? The name is a combination of foreign exchange. At its core, it's the global marketplace where one currency is exchanged for another. Think of it like this. If you've ever traveled abroad and exchanged your US dollars for euros at the airport, you've participated in a tiny part of the Forex market. But for traders, it's so much bigger. Let's look at the four key pillars that define this market. First, it's decentralized. Unlike the stock market, which has a central building like the New York Stock Exchange, the Forex market is a network of banks, brokers, and electronic systems all over the world. There's no single physical location. This is why it's often called an over-the-counter market. Second, it operates 24 hours a day, 5 days a week. Because it's global, when trading ends in New York, the market opens in Sydney and Tokyo. This gives traders incredible flexibility to trade at almost any time of day or night, from Sunday evening to Friday evening. Third, currencies always trade in pairs. You're not just buying the dollar or selling the euro. You're buying one currency while simultaneously selling another. This is why you'll always see pairs like euro to US dollar, which we'll talk about in a moment. And finally, it's defined by high liquidity. With over $7.5 trillion traded every single day, it's the most liquid market in the world. This massive volume means you can usually enter and exit trades quickly and at fair prices without worrying about being stuck in a position. Now, while there are over 180 currencies in the world, most trading activity is concentrated in a handful of pairs. These are known as the majors, and they all include the US dollar on one side. The most traded pair is the euro to US dollar, the euro against the US dollar, accounting for roughly 24% of all daily volume. It's often the most liquid and tends to have the tightest spreads, making it a favorite for beginners and professionals alike. Next, we have a US dollar to Japanese yen, the US dollar against the Japanese yen, a pair known for its sensitivity to global risk sentiment and the policies of the Bank of Japan. Then we have the pound sterling to US dollar, often called the cable, and the US dollar to Swiss franc, the US dollar against the Swiss franc. Rounding out the majors are the Australian dollar to US dollar and the US dollar to Canadian dollar, which are often referred to as commodity currencies because their values are heavily influenced by commodities like gold, iron, ore, and oil. As a beginner, I strongly recommend you start by focusing on just one or two of these major pairs. They have the most predictable patterns, the most analysis available, and are generally the most cost-effective to trade due to their low spreads. Before we go any further, we need to establish a common language. Let's break down the essential vocabulary you'll hear on every single trade. First, a pip. This stands for price interest point. It's simply the smallest standard price move a currency pair can make. For most pairs, it's the fourth decimal place. If euro to US dollar moves from 1.0875 to 1.0876, that's a movement of 1 pip. Next is the spread. This is the difference between the buy price, called the ask, and the sell price, called the bid. Think of this as the broker's commission. A tight spread is good for you because you don't have to wait for the market to move as far just to break even. Then we have leverage. This is a powerful tool. It's essentially borrowed capital from your broker that allows you to control a much larger position than your account balance would normally allow. For example, with 100:1 leverage, you can control $10,000 with just $100 of your own money. We'll talk more about the risks of this in the risk management section. Margin is the amount of money in your account that is required to open and maintain that leverage position. It's like a good faith deposit. A lot is the standardized size of a trade. A standard lot is 100,000 units of the base currency. There are also mini lots, 10,000 units, and micro lots, 1,000 units. As a beginner, you should stick to micro or mini lots to keep your risk manageable. And finally, a stop loss is perhaps the most important tool you have. It's an order you place to automatically close a trade if the market moves against you by a certain amount. It's your safety net. Now that we know the terms, let's put them together to understand a quote. Let's look at euro to US dollar, the most popular pair. Here, the euro is the base currency. It's the asset we're buying or selling. The USD is the quote currency. It's the currency we're using to price the base. On the right, you'll see two prices. The first, 1.0875, is the bid price. This is the price at which you can sell the base currency. If you want to sell your euros, you'll get $1.0875 for each one. The second, 1.0877, is the ask price. This is the price at which you can buy the base currency. If you want to buy euros, you'll pay $1.0877 for each one. Now, the difference between these two numbers is the spread. So, 1, 0.877 minus 1, 0.875 equals 0, 0.002. In Forex terms, that's 2 pips. This is the broker's fee built right into the price you see. This simple concept is the very first cost of doing business in the Forex market. When it comes to deciding which way a currency pair might move, traders generally fall into one of 3 camps, or often a combination of them. Technical analysis is the study of price itself. Technical analysts look at charts, patterns, and mathematical indicators like RSI or MACD to identify trends and predict where the price might go next. They believe all available information is already reflected in the price, so they focus purely on the chart. This is the most common approach for short-term traders. Fundamental analysis, on the other hand, looks at the bigger economic picture. A fundamental analyst studies a country's economic data, GDP, inflation reports, employment figures, and most importantly, central bank interest rate decisions. They try to assess whether a currency is undervalued or overvalued based on the health of its economy. This is often favored by long-term position traders. And then there's sentiment analysis. This is about gauging the mood of the market. Are most traders bullish or bearish? By looking at reports like the commitment of traders or retail trader positioning data, you can sometimes find contrarian opportunities when the crowd is overwhelmingly one-sided. A successful trader often learns to blend these approaches. For instance, you might use fundamental analysis to decide you want to buy the US dollar, and then use technical analysis to find the perfect entry point on a chart. Because Forex trades 24 hours a day, it's broken down into 4 major trading sessions, each named after a major financial center. The first to open is Sydney around 10 p.m. Greenwich Mean Time. This is usually a slower session with lower volume, and the most active pairs are those involving the Australian and New Zealand dollars. Next is the Tokyo session, opening at 12 a.m. Greenwich Mean Time. This session brings more volume and is the best time to trade the yen pairs, like US dollar to Japanese yen. The London session, opening at 8 a.m. Greenwich Mean Time, is widely considered the most important. It accounts for the largest volume of all sessions because of its central geographical location and the sheer number of financial institutions there. This is when the euro and British pound pairs see the most action. Finally, the New York session opens at 1 p.m. Greenwich Mean Time. The volume is high here, and it's a key time for the US dollar and Canadian dollar pairs. Now, here's the most important part for a trader, the overlap. This is when 2 sessions are open at the same time. The London-New York overlap, from 1 p.m. to 5 p.m. Greenwich Mean Time, is the golden hour. It's when volume and volatility are at their absolute peak, creating the best trading opportunities for day traders. The moves are bigger, and the liquidity is deepest. Knowing what to trade is one thing, but you also need to know how to enter and exit. That's where order types come in. A market order is the simplest. It's an order to buy or sell immediately at the current market price. You want to get in or out right now. A limit order is used when you want to enter at a better price. For example, if the price of euro to US dollar is currently 1.0900 and you want to buy if it drops to 1.0880, you would place a limit order to buy. It waits for the price to come to you. A stop order is often used to enter a trade when the price breaks a key level. If you think a breakout is happening, you might place a stop order to buy just above a resistance level. Then we have our critical risk management tools. A stop loss, as we mentioned, is an order to close a trade at a predetermined price to limit your loss. A take profit does the opposite, automatically closing a trade when it reaches your target price to secure your profit. And finally, a trailing stop is a more dynamic version of stop loss. You set it a certain number of pips away from the current price. As the price moves in your favor, the stop loss trails behind it, locking in your profit if the market suddenly reverses. It's a fantastic way to let your winners run. If there's only one section of this entire course you remember, let it be this one. Risk management is not just a part of trading, it is trading. Your only job is to manage risk effectively, and the profits will follow. The golden rule is to never risk more than 1 to 2% of your trading account on a single trade. This is non-negotiable for longevity. This leads to position sizing. It's not about how many lots you want to trade, but how many you should trade based on your risk. If you have a $10,000 account and you're willing to risk 1%, $100 on a trade, and your stop loss is 20 pips away, you need to calculate a lot size that makes that $100 loss equal to 20 pips. This discipline is what separates gamblers from traders. Next is the risk-to-reward ratio. Before you even enter a trade, you should know your potential loss and your potential profit. Aim for a ratio of at least 1 to 2 or 1 to 3. That means for every $1 you risk, you have the potential to make $2 or $3. This allows you to be profitable even if you're only right 40% of the time. Avoid diversification mistakes by not trading highly correlated pairs. If you buy both euro to US dollar and pound sterling to US dollar, you're essentially placing two bets on the same underlying move. And finally, emotional control. The market will test you. The most powerful tool you have is to set your stop loss before you enter the trade and then commit to not moving it. Discipline is the ultimate edge. Okay, so how does all of this come together? Let's walk through a step-by-step trading process you can use every single time you sit down to trade. Step 1. Choose a pair. Based on the time of day in your analysis, you select a currency pair to focus on. If it's the London-New York overlap, maybe it's euro to US dollar. Step 2. Analyze the market. You apply your method. Are you looking for a bounce off a support level? A breakout from a pattern? This is where your technical or fundamental skills come into play. Step 3. Set entry point. You determine the exact price at which you will enter the trade if your analysis plays out. Step 4. Calculate risk. Before you click buy or sell, you decide where your stop loss will go. Then, using your account size and the 1 to 2% rule, you calculate the exact position size to use. Step 5. Set take profit. You identify a logical target, perhaps a previous resistance level or a key Fibonacci level, that gives you a minimum 1 to 2 risk-to-reward ratio. Step 6. Execute and monitor. You place your trade with the stop loss and take profit attached. Then you step away. Let the trade work. Don't sit and stare at every tick. Step 7. Close and review. The trade will either hit your take profit or your stop loss. In either case, the most important step is to review it in your trading journal. What went right? What could you improve? This constant review is how you get better. Now, let's look at some of the most common pitfalls that trip up new traders. If you can avoid these, you'll be way ahead of the curve. The first is overtrading. This happens when you trade out of boredom or because you feel you have to be in a position. Remember, Sitting on your hands and waiting for a high probability setup is a valid strategy. Next is trading without a stop loss. I cannot stress this enough. Trading without a stop loss is not trading, it's gambling. You are one unexpected news event away from wiping out your account. Revenge trading is another big one. After a loss, the temptation is to immediately jump back in to get your money back. This is fueled by emotion and almost always leads to even larger losses. Ignoring the trend is another classic error. The saying, "the trend is your friend," exists for a reason. Trading against a strong, established trend is like trying to swim against a rip current. Over-leveraging is perhaps the most dangerous mistake. High leverage is a tool, but it's a double-edged sword. It can amplify your profits, but it can also amplify your losses into oblivion. Start with low leverage. And finally, having no trading plan. If you're entering trades based on a hunch or a hot tip, you have no edge. You need a documented, back-tested strategy with clear rules. So, you're ready to start. Before you even think about putting real money on the line, here's a checklist to make sure you're prepared. First, open a demo account and practice for at least 3 months. Seriously, treat that demo money like it's your own. This is where you learn the platform, test your strategies, and get comfortable with the emotional roller coaster without any financial risk. Learn to read candlestick charts. They give you so much more information about market sentiment than a simple line chart. Choose just 1 or 2 currency pairs to specialize in. Don't try to trade everything. Become an expert on the personality of one pair. Develop and backtest a trading strategy. You need a set of rules that you know from historical data has a positive expectancy. Keep a trading journal from day one. Write down every trade, why you took it, and what the outcome was. This is your most powerful learning tool. Understand the tax implications in your country. Forex trading has tax consequences, and you need to be aware of them. And the most important rule of all, only trade with money you can afford to lose. This isn't just a cliche. It's a fundamental rule for your survival and your sanity. Your broker is your partner in the market, so choosing a good one is crucial. Here are the key things to look for. The number 1 priority is regulation. Make sure your broker is regulated by a top-tier financial authority like the FCA in the UK, ASIC in Australia, or CISEC in Cyprus. This provides a layer of security and accountability for your funds. Next, look at their spreads. Compare brokers to see who offers the tightest spreads on the pairs you plan to trade. Every pip counts over the long run. The trading platform is your interface to the market. Make sure they offer a stable, user-friendly platform like MetaTrader 4 or 5, which are industry standards. Check their leverage options. A good broker will offer you flexibility, so you can choose a leverage level you're comfortable with, rather than forcing you into a maximum setting. Reliable customer support is essential. You want to know you can reach someone 24/5 if you have a technical issue with your platform or a question about your account. And finally, consider the minimum deposit. Many brokers offer accounts with very low minimum deposits, which is perfect for beginners who want to start small. So, we've covered a lot of ground today, from the basics of pips and spreads to the critical importance of risk management and a structured trading process. As we wrap up, I want to leave you with this final thought. Your Forex journey starts here, but it's a marathon, not a sprint. It's built on 4 pillars. Education first. Never stop learning. The market evolves, and you must evolve with it. Practice daily. Use that demo account to build muscle memory and refine your strategy. Stay disciplined. Your trading plan is your roadmap. Follow it, especially when emotions run high. Manage risk. This is your primary job. Protect your capital like it's your most valuable asset. Track and improve. Your trading journal is your report card. Use it to make consistent, incremental improvements. I want to leave you with a quote from a legendary trader, Alexander Elder. The goal of a successful trader is to make the best trades. Money is secondary. If you focus on the process, on making smart, well-planned, and well-managed trades, the money will follow. Thank you so much for investing your time with me today. If you found this tutorial valuable, please give it a thumbs up, share it with a friend who might be starting their journey, and subscribe to the channel and turn on the notification bell to join me for our next lesson. I'll see you in the next one. Happy trading!